So on a 1 minute chart, and that's the 6 o'clock open right there. So that's going to be the low of the new day opening gap, and the close is that price there. So the high is the close at 459, and then we'll put this small. Bada bing, bada boom. All right, she's a bit up there, and it's the, look how it's overlapping with the August 13th daily fair value gap high. So when you're looking at non-farm payroll, okay, I'm not enticing you to try to trade this. What I like to use it for is I want to see what type of liquidity they aim for. Before we get into it, non-farm payroll is not algorithmic, okay? That is not algorithmic. It is the same logic that is used in the automated form, but non-farm payroll like FOMC is a manual intervention. That means they literally pick where they want it to go abruptly, just like that. And you're encouraged not to try to trade it going into the non-farm payroll number. 20, 30 minutes after, or if you're really, really skilled, 15 minutes after, so 8:45 a.m. Eastern time, that's the earliest I would say that anyone should try to trade the non-farm payroll. Now, obviously, if you're already part of a trade and you're holding something, if you have taken something off, you can leave a little partial on to see if it gives you a little bit more juice out of that lemon. But you do not want to be trading this. If I were to trade every single non-farm payroll event before the fact, in other words, if I was trying to position ahead of it, I would have terrible stats because I don't know where they're going to run it next. I don't know that. You aren't going to know that. Just like I don't know where they're going to take FOMC. I don't know where they're going to take CPI. I don't know where they're going to take PPI. They're all manual interventions. That means that you should not be trying to position yourself ahead of them. Wait for the initial shock. Once that big crash, comes down into the marketplace where the shock and all hits it, look and see what is left behind. Like, where's the smooth edges? Because that's what they're going to go for next. Okay, so in the times that you're going to be wrong about that, okay, well, that's just one time you're wrong about it. It doesn't mean your career's over. All right, so we got about 2.5 minutes. Let's take a quick look at what we have here. Let's do it on a 15-minute time frame. And what I teach my students to do is, and before I close, I'll review the trade. One shot, one kill. I told you the turtle soup, how it forms. Told you what to look for this week with the commentary on the daily chart. All right, so we are inside this SIBI here. Here's your sell side. And the important factor is seeing which one they leave going into the 9:30 opening bell. And or do they leave it in place after the initial run for liquidity? Now, we've had a nice drop this week, so it's reasonable for it to see a return back into some intermediate term buy side, especially with the non-farm payroll. What I teach my students to do is frame out 15-minute highs and lows that are key. Relative equal highs, buy side. This one here, we do have, this, but I don't like that so much because we already hit this lower low. And we've already met the objective I had for this week, which was that August 13th daily fair value gap low. We were looking for lower prices, and I wanted to see it get down into that 18,765.25 level. All right, so here we got it. This is non-farm payroll. You want to trade that? You want to trade that? Woo! That's right, baby. Right to the buy side. I didn't like this one. This one's the one I liked. Now, if you think that you're going to trade these types of moves, if you think that's going to happen and you're going to be able to get in there and they're just going to let you ride it and you're going to get out, you're not even going to get out here. It's happening so fast and your broker is not allowing you the execution. Every broker pulls their engagement because they know that people are going to do what? They're going to over leverage, just like everybody does with these funded accounts. They over leverage, they link 20 accounts, 30 accounts, or whatever the maximum is, and they go for broke. They try to trade as much as they can be allowed to do by the funded account company because they think it's the lottery. And they know they can't trade well. So they're just trying to get lucky on one big move. So when do they know markets move around a lot? Non-farm payroll, FOMC, CPI, PPI, and they gamble. So brokers know that. They know that. So they're going to pull the opportunity away from you. That's not a lack of liquidity for the sake of buying and selling. There's a lot of people want to buy and sell. I promise you, they all want to buy and sell. But your brokers collectively are not allowing them to do that. So that's why you have this illusion, okay, of lack of liquidity. they call illiquidity, okay, or illiquid markets. Now, there's absolutely liquidity there, but the brokers are not going to allow themselves to see people go in and just run roughshod on them, because some brokers B-book. And when they B-book, these same people that they're usually taking the money from, they might get lucky that day on a heavy-handed bet, and they're not opening themselves up. So what I like about the non-farm payroll is it gives me a clue sometimes, not all the time, where it may want to trade to at 9:30. Now, how can I use the information that's been presented here? This is kind of like what I'm teaching my students over the years, where we're watching non-farm payroll. I'm not telling them what to do. Okay, nobody's trying to position ahead of it. But while we did have relative equal lows here, the fact that we took this low below that one, that already indicated that this one was more likely. That's why I said I don't like this one so much. This one is reasonable. Why? Because we've already traded down to that daily fair value gap low on August 13th. So it's reasonable for it to try to go back and run up against the trailed buy stops, which would be here. This is a 15-minute time frame. It's a bellwether time frame. So having like FOMC, PPI, CPI numbers, any kind of big high impact news driver event, the 15-minute time frame, okay, you really want to warm up to that time frame. That's the reason why I took Caleb's attention to. That's like his high time frame outside of a daily chart, obviously. His high time frame is not an hourly chart. It's not a 4-hour chart. It's just the 15-minute time frame. Then we can drop down to a 5-minute chart. Then you can drop down to a 1-minute chart or a sub 1-minute chart. And if we can appreciate the level of interest around stops that are above the marketplace or below the marketplace, the 15-minute does a really good job of highlighting where they're obviously going to be resting. A 15-minute time frame, Caleb, is your bellwether chart for determining where the obvious, clear pools of liquidity that the algorithm will refer to for that individual daily range. Okay, so what happens if you can frame a pool of liquidity like we did here? We outlined it real quick. Didn't take long, did it? Didn't take long. 15-minute relative equal highs here and this low here. And I mentioned the stark contrast was that this low was taken slightly lower than that one. And then going into the non-farm payroll, while these two may be viewed by someone else, they may say, well, look at this, this is relative equal lows. Because it's so close to that low here, if I ever see this one or something similar to this, that low being taken like that, it's already done enough to tip its hand saying, okay, at the time of that high impact news driver, FOMC, PPI, CPI, non-farm payroll like today, I'm going to elect to anticipate, let's say it that way. Just as well as I mentioned that I didn't like this one here, and this one was more favorable for a run for non-farm payroll. It could just as easily gone down, wipe this one, then one up there. Okay, so that's what I'm about to explain to you. If you can frame on your 15-minute time frame where the obvious pools of liquidity for buy side, which is here above relative equal highs, and the sell side below relative equal lows, if you can identify them both, and you should be able to do that over time by doing it every single day, this is what you should be doing also. Every section of your journal log entry, it should have your 15-minute time frame annotating at the beginning of 9:30 where the 15-minute pools of liquidity are, because that's your bellwether on the daily range, because it's going to give you every piece of information that I'm going to help build on before we close this live stream out today when I review the trade I took yesterday that carried over into today. If we can frame the idea of buy side and sell side on a 15-minute time frame, what happens if the market at a high impact or maybe even a medium impact news driver on economic calendar, forexfactory.com, but whatever economic calendar you use, you want to look for the medium or high impact news events. I don't care about the yellow or the very low impact news drivers. I don't care so much about the speeches. I do care about Fed chair. I do care about bond auctions. I do care about only the US stuff. So we're back up into the day opening gap. So isn't that beautiful? So we traded all the way back up to the buy side, which was favored over this because of that little tiny little tick below that. But what happens if it runs both sides ahead of 9:30? Like say for instance, it opened here at 8:30. If it would have taken sell side first and then went up here and took the buy side, and that range that was defined by that stays intact all the way till 9:30. What that indicates is we have a 50-50 chance that the market's going to stay inside that range and not go down and take the low out again. But what happens if it does this? It fails to take out that sell side, takes out the buy side, and then doesn't rip and keep going and crushing speed going higher. Like if it just hangs around and creates a little bit like retracement back into the first fair value gap on Thursday. But if it stays the way it is right here, and we didn't take out the sell side, it means that we could flirt with trying to make an attempt to go back down here, but I would expect it to fail. And then everybody would want to chase it going lower. And then they would do something that's like this after 9:30, going into 10 o'clock, 11:30, and then closing somewhere in the middle of the high end of the daily fair value gap on August 13th. I'm watching this over here. So I'm looking at this little section of price action. See how we went down, up, and then now down. So there's this inefficiency right here. This is the only thing that I'm watching. If it really starts to make a move above that, then we'll probably be working towards a deeper retracement post 9:30. But right now, it traded right back up into that little area here. I don't think that is a reason to stop price going higher, but that's just something I'm watching as I was talking to you. So 15-minute time frame, there's your liquidity pools, and then you strip it down from the 15-minute time frame down into a 5-minute. And levels that would be defined on this time frame, they're considered minor buy side and sell side. Okay, so you have primary buy side and sell side on a 15-minute time frame, and that's going to give you your first parameters for framing out or fleshing out a narrative for the session and or the daily range. So one of the things I like watching in other live streamers and other YouTube channels that are very upfront, and they tell you what they believe, what they think, their opinions, and some of them are actually executing on them. I'm thankful that they're willing to do that because they create pools of liquidity in sentiment. And it allows them, when they get on their YouTube channel, and this is not a knock against any individual YouTuber, I'm focusing on their audience because that's what I'm watching. All they're doing is creating another watering hole. So when I'm watching other YouTubers, it's a watering hole. Animals are going to go out to that watering hole and they're going to try to get a drink. And they're either chasing what this person's doing in their YouTube stream, which I don't ever, there's nobody out there I want to follow. Not one, okay? But I like watching my students, but I like watching specifically a number of YouTubers that have a decent following, and their animation around a particular bias for the day. If they think a certain level is going to be hit, and for instance, let's roll back in time. Let's just say right before 8:30, say it wasn't non-farm payroll, and we weren't going to have this fast run in price. The way I just framed out the sell side and the buy side, real time in front of you, I would have those same levels annotated the same way. It just means that it's likely to take a little bit longer to get to them because it's not a non-farm payroll, FOMC, CPI, or PPI type event driving price right to it. So because resource that we have in YouTube, it allows the folks to have a chat window and whatever. By watching the sentiment shifting, and if I see another YouTube channel that I watch and I think that they have a very busy channel with chat, I love that. And I'm not engaging in their chat, but sometimes I'll throw a bone out there, and then all of a sudden Billy Big Ass, he'll say something, and then that's what I'm looking for. I want the Joker to raise his head up, because as soon as he does that, somebody else is either going to say, no, I don't think that's going to happen, and then a wave of other people saying, yeah, you're right, that's not right, or they'll support him. I want their opinion. If I see predominantly most of the people that I'm watching, sentiment-wise, if they're saying they think it's going to go down, and I'm already seeing things like this low went lower than that one, and this one is relatively equal. See, there's this high here didn't go above that high, even though these could be framed, if you're looking at it that way, that would be a relative equal high. But this is high probability. Why? Because this high is lower than that one. So this high over here is lower than that one. But you don't have that here, do you? You have this lower, and then you got this one over here, where it's just like, it's already disturbed it. It's disturbed that liquidity. Where here, it's a little bit more blocky looking, where this is a wick. If this wick gets overtaken, like it does here, that means it took a real run on liquidity, versus like how I treat a wick. I'll break that down into quadrants, and more specifically the halfway point. If I see a wick like this and we're above it, I want to see it trade down into the upper half of it, but not even go below the midpoint of it. But in this leg lower, it passed through that easily and spent time down there. What was it doing? It was accumulating. So you don't have those signatures up here. It's more blocky. So that makes this a better candidate for a high impact or a medium impact news driver, drawing to that. But if it's not a high impact news event, like the PPI number that comes out, the CPI number, if a FOMC rate announcement comes out in the afternoon, 2:30 in the conference call, and then you have like a non-farm payroll event here, excluding them, everything else, if it's on economic calendar with a medium impact, I would expect that same type of thing unfolding here. It just would be a gradual trading up to that level for the buy side. It's affording me the moment where I framed where the liquidity is, and then I'm actually getting a dynamic sentiment reading by people that have a vested interest in looking right on social media. Think about that. I want to see how much traction it gains by anyone else in that chat room. That's how I'm using other YouTubers' streams. And if they start cheerleading the idea, oh, yeah, I like that idea, but my target's a little bit past that. That's exactly what I want to hear. I want to hear that stuff like this. Yeah, I want to see it go below that low here. I want to aim for 18,680. And then somebody else will come behind and say, no, I'm looking for 660, bro. That's exactly what I'm looking for. Because now I'm arm wrestling them as smart money against dumb money, street money. What you have at that very moment is the purest form of sentiment at a very specific time where it's diametrically opposed to what the algorithm is going to do. Who do you think is going to win that? Dumb money is going to fall on the sword of smart money. If the 15-minute time frame buy side and sell side liquidity pools are defined, it gives you an initial context. But every big name, my advice is quietly, respectfully, in anonymity, start watching their chat windows, because I'm using that as the best sentiment indicator, because I know what I'm looking for technically. I'm looking for something to take place, to draw to a specific price level, to behave a certain way. And I have made that known to you. I told you every step of the way what I'm looking for. I'm using higher time frame charts to tell you what I think narrative wise, but intraday, I can trade both sides. It's not a problem to do that. But if we're looking for that low on August 13th on the fair value gap, which I'll take you up to the chart in a second, that was where I wanted to see it trade down to this week. Once it hits that, I'm done. I'm not personally looking for anything lower. Can it go lower? Absolutely can, but I'm not going to be on that. Why? Because I'm sailing into the weekend. When we drop down from a 15-minute time frame to a 5-minute chart, then you start seeing smaller pools of liquidity. And what would that look like? Well, inside of this low and this high, that's your range. So if we think by dividing up the characteristics that the buy side liquidity pool has in contrast to what the sell side, the fact that this wick was overtaken, that to me is more indicative of this was a real stop hunt versus this blockiness. Okay, it's just real smooth compared to this. Would you agree? This is a little bit more jagged, more piercing versus all of this blockiness. So this is more likely to be drawn to on the basis of just the way the price printed it. Then you add to it, what day of the week is it? It's Friday. What direction primarily has this week been doing? Has it been going up all week? Has it been going down all week? Clearly, it's been going down all week. We had a big old Tuesday drop down, okay, the first part of the morning. I wasn't part of that. I don't need to be in there every day. I know how to catch up. I will let the market tell me what it wants to do. I want the setups to come to me, as I'll indicate when we break down that trade. But you have to look at price and discern when you're going to engage, when you're not going to. And once you have that 15-minute time frame defined, this is your dealing range. This is your high, and this is your low. What is the daily range, and or specifically, what's the morning session going to do with that range? Is it going to stay inside of it? Or is it going to trade just outside the low of it? Or is it going to trade just outside the high of it? Is it going to run both sides first? And if it's going to run both sides, which side does it run first? In this case, it ran to the buy side. But it stacks the odds against this being a prolonged move lower for me personally, because it's Friday. It's fulfilled my high time frame daily objective by going into that August 13th daily low fair value gap low. And that sounds like a whole lot of mumbo jumbo, but when we go back to the daily chart, you're going to see exactly what I'm talking about. And it's going to make perfect sense. After the 15-minute time frame is defined, where you have both buy side and sell side, dropping down to a 5-minute chart, then you can start looking at things like this, where this is a high, slightly lower high. So these are relatively equal. You might not see it that way. That's what I'm teaching my son to view it as. So buy side is defined with this high here. What kind of high would that be? What kind of buy side specifically would that be? A minor buy side liquidity pool. So you'd annotate it like this. So this is a minor buy side liquidity pool. And then we have, again, right in here, see these? So that same thing. So you can highlight, not the edge of it, highlight the line, hold down control, drag your mouse away from it, and it'll copy it. Put it on the higher of the two highs and extend that over. So you have a primary sell side liquidity pool, primary buy side liquidity pool. What makes it primary? It's a 15-minute time frame dealing range. So that way it tells you what you are going to frame your session and or daily range around initially, because you have to have a starting point, right? But that 5-minute chart will break down that range from this high down to that low into smaller buy side and sell side liquidity pools. So what are we seeing here inside this range? Primarily it's buy side. Okay, we have a lower run here below a wick, so that means this is a little bit more jagged. It's Friday. It's been going down all week. So which side is non-farm payroll most likely? Not all the time. Not a panacea. Not a be-all, end-all. It's always going to work this way because ICT said so. It's just my protocol. This is what I teach my students to look at price like this, to anticipate where the market is likely to go. I do the same thing with PPI and CPI. And I sometimes, and I'm talking about maybe 2% of the time, get it right. If we start looking at that range and we see there's a buy side here, there's a buy side here in a 5-minute chart, we can see how these are treated in the realm of how far we're going to reach back to that buy side, because we already determined that that's more likely. How we trade at that first minor buy side, that's going to give you a clue. It trades up to it here, and then watch what it does. Jams down. What's that doing? Taking out that short-term low, but it is not going below that low here. So as soon as this candle closes there, this one here is the next one that is considered. It trades above it, right back down in, and then rips through the buy side. One shot, one kill. That's a sniper euphemism. And you're looking for these very specific conditions where the thing that you're going to trade on, that's your premium rate. That's your little fair value gap. When price steps into that fair value gap, as soon as that price hits the consequent encroachment or starts to approach it, it's in your crosshairs and you're bullish. That means you're going to do what? When price enters that fair value gap, you fire. Your stop gets placed below the imbalance candle if it's a bullish fair value gap, or above the high of the imbalance candle if it's a bearish fair value gap. See it. So we're at the top of that inefficiency I mentioned over here earlier, right here. And then we have these relative equal highs here. I don't personally like to have these things on my chart because I have to show you as students what I have written down on my notepad. For instance, when I was mentioning this over here, real time looking at it, and I'd simply just write down key levels. And what I do is I look at the previous day's high and the previous day's low, and then I layer every level that's pertinent to that range and just below it or just above it. And I have it in raw numerical format, just like that. But as soon as I mention this here, I'm scribbling in my observations on that level, what time frame I noticed it on. And then what I'm constantly doing is I'm looking at price over here. I'm watching this over here, this raw number, more than I'm watching the chart over here. The chart is the language that you're learning from me talking about what price should do. When I'm looking at price action, I'm showing you things that form in price around the same time, around the same price that these other things occur algorithmically. When they agree, you should arrive at that assumption about what price should do or how it should behave or how you should observe it at that moment or any given time frame, okay? So that's the exchange of information and the language that I use by doing so. I'm more concerned about what price is doing at what time, and every time it's fluctuating up and down in relationship to these raw numbers on this same price axis. So because it's Friday, I'd like to see it run up in here and take that buy side. It doesn't need to do it right out the gate, but that's something that is reasonable. And then you have this inefficiency down here where the consequent encroachment of that August 13th daily fair value gap, which we're going to look at in just 2 or 3 more minutes. All right, so anyway, we went through the business of picking out why that buy side is here, and we've opened up, and let's look at the opening range. All right, so we have a little bit of an opening range gap still here. So you have a little bit of portion of it opened up here. So it tried to get up in there, wait for it to open, but left this little portion open here. Watch this low, and we're back inside of first fair value gap. So we're inside this little tiny inefficiency here, and previous settlements up here. All right, so I can take this one off. We don't need that anymore. We don't need this anymore. We don't need that buy side anymore. We don't need the minors anymore here. Actually, we do. I didn't drop down to when I was talking about the minor 5-minute buy side liquidity pool and sell side liquidity pools. You can see how when we drop down to the 1 minute time frame, which is, I like using the 1 minute because it's very, very detail oriented. So if I'm looking at that same level here that was arrived at on the 5-minute chart with these relative equal highs, when price ran through that, let's look at it in contrast on the 5-minute chart real quick. Here it goes, it rips through it one single time on that one candle right there. You see that? So you don't really have a chance to see much in this one single candlestick unless you're watching the fluctuations of price over here, which is what I'm primarily doing when I'm watching price. Don't try to do this part. What I'm trying to describe to you, what I'm doing, that is me having more insight than you have, and I'm not going to teach all that. This 5-minute candlestick only has this one single range here when it crosses above that level here. But watch what happens when we go back into the 1-minute chart. This candlestick does that business of wicking around, but look what happens next. We open, we trade right back down to that buy side, right in here, using it, and then comes back to the order block right there. Take a step back and then read what it's telling us. What's price trying to indicate to us? It defended initially what? The sell side. It's more likely it's going to draw up into take out buy side. Okay, but it left the sell side. For me, for my personal taste, I wouldn't want to take a short reaching for the sell side on that 15-minute time frame. So below these lows here, that sell side hasn't been engaged yet. I'm not interested in taking that trade because what I had set up for as a downside objective was already arrived at, and you saw me execute on that. So when that daily fair value gap low was traded to, I'm no longer interested in being a participant in this weekly candle. I'm done. It expired for me. I'll miss moves if it keeps going lower. That's okay. So let's go into what we're going to do here. Let's go into, okay. So we are looking at price action negative. If we look at daily chart, let's go to a daily chart. If you recall what I outlined on the daily chart for NQ last week and going into this week, you'll see that in the live streams. You'll see that also in the markups and the screenshots that I was teaching Caleb to do. I'll flesh this out real quick for you again, so that way you can see it. I mentioned how we were likely to trade down into this fair value gap for the week. That's what I wanted to see happen this week. So because we have that, you want to annotate that level because it's going to give you your price level over here on the blue. That way we're highlighting this candlestick, that candle's low. So that high and this candle's low, and this one single candle, see this right here? That little fluctuation between this candle's high and that following candle's low, that area right there, that is a fair value gap. It's a buy side imbalance, sell side inefficiency. That means for the market to efficiently deliver fair value pricing, this buy side imbalance, sell side inefficiency is lacking what? Efficient delivery on the downside. That means sell side delivery. So for every range that goes up, an efficient delivery model is the price has to be offered going back down the same range. That's what a fair value gap is. This one here was outlined to you in advance, and I told you that I was looking for that as a downside objective this week. Notice what goes on beyond that candlestick's high to the left. Look over to the left. What do you see? Well, the first candle is this one here, the body in that. So you have a volume imbalance down here. So let's play devil's advocate for a second. If price wants to go lower, maybe it goes lower today. I won't be on board with it. I'm done. I'm not going to try to take any more trades today. This volume imbalance would be the next draw on liquidity that goes below the consequent encroachment of this wick. So you would define the range like this. So while where we're at right now in price, we're up here. Half of that wick, that's consequent encroachment. Look how close we got to it. The volume imbalance down here is the next one. Then you have this wick, you would do the same thing, and that basically lays inside of this volume imbalance. And then the same thing here, and the same thing with these wicks, all these discount wicks. You want to annotate those. Those are levels that I'm going to have on my notepad should we get below this on a closing basis. This being this candlestick's high, which forms this fair value gap. So as we start to trade down, this is a lot of balanced price range. What makes it balanced price range? It's offering sell side delivery. It means any movement, like when it drops like this is sell side delivery. This candlestick's closed up is buy side delivery. It just simply means that the market has gone up or down. It's going up to go into inefficiencies above market price, or it's going up to take out buy side liquidity. That means buy stops. It drops to go down to an inefficiency below market price. It's like a fair value gap or something like that. Or it goes below old lows for sell stops. So that's the only two mechanisms that causes price to go up or down. There's nothing else. What happens when price has a goal? It's being inspired to get to a particular price level. It will skip. It'll create these little gaps. These gaps are what we are targeting, because if we're aiming for, just know that we have a lot of things to factor in here. If we go lower, it's going to be potentially spotty, because then we have all this back and forth in here. So it's going to take a real move to get through all this mess in here. We have volume imbalances. Like, this is a mess. Like, this is a lot of sloppy stuff in here. The cleanest price delivery was moving from here down into this inefficiency. That's why I said this ends it for me. I'm done for the week. If it touches this level here, which is where you saw my cover on my short, that's it for me. Because then what has happened is, to expecting lower prices, I'm going to have to weather through all these questionable levels. Can it go down there and smash right through it? Absolutely it can. Is it likely to do that? No. So am I trading with high probability if I'm holding onto my short? If I would have held onto my short, I would have been nervous with the non-farm payroll release. I would have been nervous after 9:30 opening, because I have all these other factors to start weighing out. Okay, should I hold on my trade? Should I not? Versus I know what I was looking for in the commentary and the analysis for this week. We were already eyeballing this. Okay, the low end of it, that's the best target. That's the best. So I had my limit order to get that, knowing that because it's Friday, it's non-farm payroll, it's going to be probably a little bit more animated. It may color outside the lines and go just below that candlestick's high. So that was me finessing. You can see me in the video adjusting my limit order, because I want to make sure I get the best factoring the spread. My original profit objective would have made me a couple $100 more, but I wanted to make sure that the spread touching this candlestick's high, when it trades down there, I want to be executed. I want to get those 14 contracts off. So if those 14 contracts get peeled off, I have to have a price level with that limit order to cover that short position that will afford me the opportunity to see 14 contracts clear. You're not getting 765.25 with your exit, not while you're trying to groom yourself into seeing these things pan out consistently. You want to be able to afford yourself an exit. So you expect to touch that level with price, and that's your moral victory. That's your trophy. And that's what you put in your journal. I'm pleased. I'm excited. I was so stoked to see price trade down to that level. It was amazing to see it drop down there and hit that perfectly. And you note the time, and you put a little screenshot, and you say, this is what it feels like for we're holding onto a trade and it pans out like this. But I'm happy and I'm comfortable that I don't need to have that level of precision for exits. I'm growing in my precision. So in this case, instead of getting 18,765.25 as your limit, would have to be 18,765.50. That is not much wiggle room. That is, and that's not a lot. Like, you could very easily not get filled if it stops dead on its delivery at 765.25. How many contracts are going to be traded at that price with one tick variance, right? So if you went into it with the 18,770 level, say this is your price that you're trying to get, like you can't even barely see it, right? It's not much of a difference. And you're going to argue, say that's not precise enough. Knowing where it's going to go to with the perfection, that is just for you to feel good. That's not how you're going to execute. If you try to do that, you're going to miss entries, you're going to miss exits, and or hold on to them because you want them to hit that level with your exit, and then the price could be returning against you. And you are more fixed on the outcome being perfect versus recognizing that you're in a trade now that's turned around on you. And that's the levels I'm using going forward. So we'll keep those in mind. But this fair value gap is what I was mentioning this week. That was all I was looking for. Me personally, as the trader, ICT, I'm not interested needing it to go lower than that. Can it? Absolutely can. So where do I want to engage? I want to engage in anything that gets me short. So how can I do that? How can I frame a short in a market that has had this big, colossal slide down, where I had some of the back end of that move, but I didn't get the first part of it there because it's coming on the heels of what? A holiday. So I'm going to let the morning session trade without me. And at 1:30 p.m., that means the New York hour lunch, which is technically 2 hours, 11:30 to 1:30. In that time frame, that is when the lunch macro, whatever has happened in the morning session, during those 2 hours, there's always some kind of retracement against whatever's already happened in the morning. That is all the lunch macro is. That's it. It's all it is. It just retraces on Orders that would be trailed up if it's been going higher, or if it's been going lower in price, they trail the stop losses lower to lock in their profits. During the 11:30 to 1:30, they're very, very specific times. Don't take my word for it. I want you to go back, and every single time you log intraday price action, make a vertical line at 11:30 and a vertical line at 1:30. And then watch what price is doing in those 2 hours. It does it so frequently that could be your model. That could be your thing. Like, you don't even trade. Don't even worry about trading the open. Who cares about that? Whatever somebody's been doing, they were smart. They did something right. They were long in the initial run of the move, or they were short in the initial run of the move. During that 11:30 to 12:30, 11:30 to 1:30 p.m. Eastern Standard Time. That means, and at 11:30 and 1:30, that defines your lunch macro time. But at the end of that, at 1:30 p.m. Eastern Standard Time, that starts the afternoon session. So that's your first 30 minutes leading up to 2 o'clock. In that first 30 minutes, you're going to see fair value gaps form. You're going to see other PDA, breaker blocks, vacuum blocks, propulsion blocks, institutional order flow, entry drill. Technically, it's still kind of fair value gap. Every PDA array is in there. Volume imbalance. If it forms the first one, it's the same premise. If you look at the drop here on Tuesday, I was in the latter half of it. The next day, at Wednesday, we have a candlestick high here. Now watch. That is your SIBI. It's your sell side imbalance, buy side inefficiency. This big displacement lower here, this up close candle and this up close candle, that makes all one singular bearish order block. It's not the last up close candle. When I taught it initially, I taught it that way because I knew everybody's going to come out there and start teaching courses with it. Because of this displacement lower, we can't use this candlestick high here to that candlestick's low. We have to refer to the truest beginning point of the order block, which is this run up. Okay, something here came into the marketplace that was unbeknownst to me. I don't care. I'm not trading in the morning session, but I saw what it was doing. So I went in and I worked with the position of getting short inside of this daily range, the latter portion of it, the afternoon session, post 1:30 p.m. So we have to look at this candlestick here. So what 3 price points here on this candlestick are pertinent or useful? We're down into the volume imbalance. See that? And now what you'll do is you will look at this wick here, and you'll look at this wick here. Divide that in half on both of them. The difference between this candlestick's low and that candlestick's low. Okay, you see that? What is that? That's your fair value gap. This is just a SIBI. This is a fair value gap. And this is why when I look at other people on YouTube and they'll say, look, here's a fair value gap. That's not a fair value gap. That's not a imbalance that I'm going to utilize. So if you look at the low here to that candlestick's high, that's your real fair value gap. Other folks on the internet may see this and say, okay, ICT says that the best portion of shorts are going to occur in the lower half of that, and we'll leave the upper half open. And that is true when you're trading and utilizing a fair value gap that is a SIBI, but that is not what's going on here. That's why I tell you all the time, there is no one trick pony explanation for a fair value gap. You have to understand other factors and other PD arrays. That is not what we're seeing here. This is a change in the state of delivery right there, that opening price. In a perfect world, price would do this. It would trade up to that level there, maybe just a little bit above it, and then roll over and go lower. That's the perfect world. If we're thinking about things algorithmically, and I'm teaching you how to use these PD arrays properly, not look for an imbalance that completely closes in, then I'm going to go long or short based on that. That is the worst approach to doing that. Why would you want to do that? You don't want to see them fill in. So if this is the change in the state of delivery, that means the price was offered going up. So this is buy side delivery. That means the movement of price is going up. Then you have this displacement lower that overtakes that candlestick's low. Your reference point goes right back to that opening price. That's the change in the state of delivery. If you look at this price right here, this is on well, let's just do it. And if I talk about it, it's one thing. But we're going to look at Tuesday's price action, September 3rd, and the price is being annotated here on that opening candle, that price of that opening on this individual candlestick. So when we drop down to a lower time frame, this blue line is referencing this candlestick's opening price. Okay, let's watch. We'll drop down to an hourly chart. What's going on there? It's leaving all this open. Light bulbs are coming on. Let me go back to the daily chart. I want you to fully understand what I'm showing you. This candlestick, that opening price, we're drawing that out in the future. When price reaches this level, this box here is highlighting. So if we drop back down to a 60-minute chart, all right, so you can see what I was referring to here, where price was wicking into that. So here's that opening price. on that daily candlestick, that little movement to the downside, and then it rallied up. Then we had that roll over on Tuesday. Right at this moment here, look what price is doing. It's opening and trading right back up to it. It's leaving all of this open, and it's leaving all of this open. This inefficiency right here, and this inefficiency, it should never be traded to. Why would you expect these two fair value gaps to ever be considered at all? If it's inside of that bearish fair value gap and it's above the change in the state of delivery, that means it's going to do what? It's just going to go into it a little bit. And then you want to see these things stay open because that indicates that we're really heavy. We don't need to see it go back up in the air. Now, because we have that, we can drop down to a 15-minute time frame. All right, so here's that opening price on the daily candlestick, and it's the change in the state of delivery, and you can see it wicking up into it. We saw on that hourly chart. Now we're on a 15-minute time frame, trading into it here, and that defines that 15-minute, or sorry, hourly inefficiency, the downside. It's just a SIBI. That's not a fair value gap that you trade. Okay, it's just showing an inefficiency. Just because there's an inefficiency doesn't mean it needs to trade up into it. You want to see where you are in the lay of the land. Where is price at? Where is it likely to go? And how's it been delivered? These two inefficiencies in price, we don't want them to trade to them. We don't want to see price go up there. But watch what happens when it starts to break lower. After returning back to that blue line, which is the opening price on the lower up close candle on the daily chart, it frames the full bearish order block. This is what you end up doing with this information. Okay, this is all part of the price delivery continuum theory. Knowing what you're looking for from one higher time frame, and then using the information from that higher time frame, what should you expect to see in price? So it gives me the confidence. It gives me, I know what I'm looking for. I know what I'm going to trade off of. I know how I'm going to place my stop based on this information. Big, huge paradigm shift. Ready? So it trades up into the opening of that lowest up close candle that makes the bearish order block. This is the change in the state of delivery. The algorithm is going to refer back to that price. Here we are on a 15-minute time frame. Does it wick above it? Yes. Does it wick above it? Yes. Does it wick above it? Yes. How can you validate that that is really going to be an influential order block, ICT? Look at this lower time frame. What are the bodies doing? What are they doing? Are they just going through it? No, they're respecting it. So if I can see a time frame like this that's confirming it, that means this up close candle becomes a valid bearish order block. And then I can use its opening price right here. We get that on that candlestick right there. We don't need a close below it. We have that opening price and we get it there. So that validates this as an order block. But now watch, when it does this, the next candle, what does it create? What's this? That's your first presentation. Oh, so it's not limited to 9:30 to 10 o'clock. Right. It's when you're using proper breakdown from a higher time frame down to a lower time frame, using the PD arrays in the proper context and its PD array matrix, where we're at in the lay of the land, that fair value gap, you can trade that right there. Where's your stop go? It's got to be above the order block. So your risk is entry. The lowest threshold entry is this candlestick's high. The fair value gap is here. That candlestick's high is 19,183.25. So that's your entry minus one tick. So you want to get a fill. You want to make sure that you're going to get filled. That's it. Why? Because you have all these other things qualifying and confirming it. But your risk is the candlestick that is the bearish order block, this one here, because it should not go back above that. This candlestick up close is your bearish order block. We don't know that yet until this candlestick crosses down below the opening price. It does not, on this candlestick, it does not need to close below the opening price of that to validate that as a bearish order block. What's good about this is we had this candlestick already trade above this up close candle, which is a potential, we don't know it yet, bearish order block. It wicked above its high there and it wicked above its high there. And then on this candlestick, we traded below that candlestick's opening. That validates that candlestick as a bearish order block. Any stop in this close proximity, you could use the opening of that candlestick right here. That right there, you could be entering and you can add more into it, into the fair value gap if it trades up into it. You know, that's what I'm saying. Like you can use that as your entry mechanism. But for stop placement, you have to use the high of that candlestick plus one tick, and it never goes there. So that's your defined risk from this candlestick high minus one tick, that's your entry, to this candlestick plus one tick above its high. So that's your defined risk. And you can see multiple instances where you can get in and get short on that idea, that premise. Anyway, let's go back out to a daily chart. So here is the other wick. Beautiful delivery there. You want to screenshot that, by the way. All this business in here, we are not looking for that to trade up into these inefficiencies. They should stay open. So in reality, what we're saying is this candlestick's low and this candlestick's high. That's your real That's your real fair value gap. Now, let's think about this for a moment, okay? If that's your fair value gap, this is your high on the fair value gap, which is the low of the fair value gap, and this candlestick's low is the high of the fair value gap. So that defined range there, this section of price is inefficient in what buy side delivery because this candle moved lower. So in this little section of price action between this candlestick's low and this candlestick's high, we're only focused in this little shaded area. We wait for price to go up into it because what is that doing? It's offering the sell side delivery. That means it's overlapping this down movement between this candle's low and this candle's high. It's inefficient because it didn't have any other candlestick cross over the range defined by this candle's low and this candle's high while price was going up. And then you're going to have these little porous pockets where it didn't create a very smooth delivery of price action. We'll see that when we drop back down to lower time frames. But here it looks, you can't see that. So the only way you can see it on this time frame is defining with a fair value gap, which is why I created that concept. Then this run back up into it is overlapping that, even though it wicked and went lower, that delivery right there, that's what I'm studying that. When I was setting up that turtle soup cell, what did I teach you about turtle soups? They're reversal patterns and they're continuation patterns. You can use the fair value gap to get into a turtle soup. This level here, I'm gonna color this one so that way it'll be this pink reddish area that's highlighted to this candlestick's low. We're highlighting this inefficiency because it's defined by this candle's high, that candle's low. This candle's high is anchored with that broad orange color. And we're going to look at what price was doing here yesterday. And that's what I was utilizing to get short in the turtle soup. And then everything will become perfect. You'll have a clear depiction of what price is going to do because I'm showing you how I executed yesterday. My focus and aim was this candlestick high on Wednesday. That run above that, that's my turtle soup. So if I'm looking for this level down here, so between this candlestick's low, this candlestick's high, something in here, I want to attack it. I'm waiting for them to give me a high, a short-term high around time of day that I want to trade. And then I'm going to wait for it to pierce that high. That's turtle soup. What I just said will make sense in a minute when we drop down lower time frames. But I'm thinking that I want to be short above this high and aim for this level right here. That's a one-shot, one kill. That's my focus. I want to be above this price and aim for that one. I'm willing to absorb and ride out all the little fluctuations between where I get in at and where my initial stop loss is to where I'm aiming for. That's down here, okay? How do we accomplish that? Well, glad you asked. Let's go down to a hourly chart. Remember, this orange line is this candlestick's high, so it has to be an entry for shorting above that level. My entry to get short has to be above this candlestick's high. So that's this price up here. Look at this right here. This candlestick's high, my entry going short has to be above that, as much as this candlestick's low. Watch this price right here. So I have a range of looking for a short in that general proximity. I'm waiting for something to form, technically affording me a short where I can frame a stop loss using the language I'm teaching you so that way you can see it conceptually. We're in this little area. The opportunity is from here to here, okay? So now drop hourly. So we have this old high, and inside this range here, what's it reaching for? When it wicked up like this, what is it reaching for? Look over to the left. What is all this? That was me framing the order block up here. And then you have all these wicks, which becomes what? Balanced price range. Why? Why is this balanced? Because we have this candlestick opening, trading up here. We have this candlestick opening and trading up here. We have this candlestick opening and trading up here. So essentially what you're seeing is you're seeing a wall of price action that's been delivered. It's offered buy side and sell side all throughout this range here. And then it leaves it right there. So that means that I can take that idea and say, I'm going to extend this over here. And once it gets into that area, it should have no easy path into all this stuff or higher. So now I'm further refining this down into a small little pocket of price range. So yes, it can touch this, but before we get to that range, when it's trading above this high here, when it's doing this movement on the hourly, what can I use as an initial framework to say, okay, where's my focus at? It's going up to this level, an extreme level, but it's going to have a real hard time getting above that because we've seen back and forth individual candlesticks overlapping in the same range. Then we have this right there where it leaves that balanced price range and it leaves this little tiny little section of price action exposed with inefficiency. What is it inefficient in? It's sell side delivery, but buy side inefficient. That means it's got to have at some time in the future, after this candlestick closes and this one starts, to efficiently all further market, fair value pricing, this gap is what it is, should be repriced to with buy-side delivery. That means movement up in price. And we get that here. See how it's starting to flesh out more and more. So now we have this wall of price action, this fair value gap. We're going to drop down into a 15-minute time frame. So here's that high where the little orange level was anchored to. And this gap here is above this old high, and we're trading up. I want to try to take a short as it's trading higher. As it goes higher, I want to sell short into that, because it's going into that inefficiency. I had that big wall of price action. Remember on the hourly chart? It's all those wicks that was saying I'm a balanced price range. It might touch me, but I'm not going anywhere. I'm going to keep price from going any higher. But the wicks can do what? They are allowed to do the damage. That means they can color just outside the lines. So we're seeing that happen here. There's the fair value gap range. It's expanding just a little bit outside of it. But more importantly, my focus is I'm getting above that high right there, because this is all part of a daily fair value gap institutional order flow entry drill. That means I expect it not to completely close in a bearish fair value gap. I want to see it just go in a little bit like it's doing right here. And I want to see it immediately send price lower. Okay, now we can drop down to a 5-minute chart. Everything starts getting more and more scientific, doesn't it? If I'm watching this time frame, what do I want to see in price? Well, what does my price delivery continuum theory teach you? The higher time frame order flow, any PD array that you're using on a higher time frame, which higher than a 5-minute chart, a 6-minute chart, a 7-minute chart, an 8-minute chart, anything higher than a 5-minute chart. So what are my usual picks? I use the industry standards because I want to have this little disruption to what you're used to if you come from other schools of thought. So everybody understands the monthly, the weekly, the daily, the 4-hour, the 1 hour, the 15-minute, the 5-minute, the 1-minute. The previous higher time frame gave us this pink shaded area for the fair value gap to be defined. I laid the rectangle on it based on the higher time frame. And now because it's transposed to this time frame, now we're on a 5-minute chart, what are the bodies telling me? They're respecting it, aren't they? So I'm getting closer and closer to what it is I'm looking for. Because every frame of reference for time, because that's the most paramount thing, time is the most important factor before price does anything. Because if it ain't the right time, price ain't going nowhere, period. The bodies are saying, yeah, we're respecting that. We're not going to color outside the lines, but the wicks will. But what I'm teaching you is how to use the top-down approach and use the price delivery continuum theory, which is whatever the higher time frame PD arrays have done at a higher time frame chart, the lower ones should start respecting that PD array as you see here. We allow those wicks to color outside that. It's normal for that to happen. But what I'm watching is what do the bodies do? Are the bodies going beyond the PD array that I'm using to anchor my analysis on the higher time frame chart? In this case, we've seen what? No, it doesn't do that. No, it's not doing that at all. When you're looking at a fair value gap, how far can it go outside of the range that defines that fair value gap and still be good? How wide is the fair value gap? Because the wick can do that range outside of it. That's one standard deviation on the fair value gap. That is not changing anything for me. If it starts going above it a little bit like that, you've seen me annotate trades. It's a mohawk. That's what I type it as. It's a mohawk. It's just a little tiny little stray hair. Well, that's what the algorithm's doing. It's just coloring outside the lines a little bit, but the standard deviation of whatever that PD array or inefficiency is. The fair value gaps, when you're looking at them like this, they're being refined smaller and smaller and smaller. They're not going to go 5 times this, okay? And then so it's a good trade. It's going to be within the realm of whatever this fair value gap width is. It can color outside the line that much. Generally, it won't do that much at all, but that's the rules for it. Watch what happens when we use the same logic going down into the 1-minute chart. This is a market maker sell model. Where's your consolidation? Right here. Why are you picking that, ICD? Why aren't you using this down here? Because this is all impulsive price action. It's real sharp. We don't want that. Our eye goes for the original what? What's the rules for a market maker sell model and buy model? The original consolidation. That means your eye is looking for a perfect little box of price action. Well, can you see that this to this, those are relatively equal lows, right? Go straight up from there. What do you have? That's your original consolidation. Inside the original consolidation, go back to the original rules. This is old stuff. It can drop down slightly below that low right there, which is what you get. And then once it leaves it, it can touch what? The original consolidation high. Expansion up, first stage accumulation, reaccumulation, or second stage reaccumulation. Then it rallies up and creates what? Smart money reversal. How does smart money know to sell short at the highs like that? That was the question I had. What I learned is what you think about what the markets are doing are not at all doing that. So by having what is really going on versus how I can communicate that in a price chart, that's what you're seeing here. So when price is trading up into this area, what time is this? It's after the opening range of 9:30 to 10 o'clock. So we now have the market trading inside of our fair value gap. But now that's the first time it can trade there. So anyone that wants to go short, just as because it rallies up higher like that, just give it a chance. Give it a chance to let people go after it, because it's the second mouse that gets the cheese. This is the cheese right here. It's baited. That's the area that everybody would want to get if they understood what I'm teaching. They want to get that price level. It's real high. It's nice. But they don't understand the market maker sell model, which is consolidation, maybe a stop hunt initially, rallies, touch the original consolidation, rally higher, accumulate. Second stage, reaccumulation. Then it rallies and takes out a higher high right there. It's coloring outside. We saw it on the hourly. We saw it on the 15-minute time. We saw it on the 5-minute chart. There was wicks up here, right? That's what these bodies are on a 1-minute chart. That is completely permissible. We're not going to look at the bodies of a 1-minute time frame when the higher time frame, hourly, 15-minute, and 5-minute, are showing just the wick. The 1-minute chart's going to have bodies there. Just like when you're looking at a 1-minute chart, if you look at the wick on this candlestick here, go down to a 15-second or 5-second chart, you're going to see bodies on that time frame. It's completely reasonable to expect that. But watch, when price takes out this high here, and we're inside this area as well, I want to be selling short. I want to get short in there. I want to add more if it can afford me outside the coloring of that shaded area. That's premium pricing. Like, that's really good. That's like you selling your house for $100,000 more than what you were originally aiming to do. Who's gonna be mad about that? Nobody is. And so since I'm aiming for something in this area here and targeting all the way down to that black line right there, in my mind, I'm thinking this is the beginning, this is the inception of the trade, and this is my terminus down here. I don't care what this is all gonna require of me, because I'm not going to chase my stop loss throughout all that range. I'm going to wait for logical price points, and then once I place my stop, I'm going to sit still. That's one shot, one kill, because I'm taking down my mark. My mark is this level down here. That's the low of that fair value gap on the daily chart. So now when we have this smart money reversal, you don't need that. Wait for it to break in market structure. That's what you get with this little high here. I'm sorry, this low. We get it right there. And then we trade back up into what? The order block. Where's the change in state of delivery on that? That opening price on that candlestick right there. So if this is in fact correct, any little retracements up should not take out this high, and our premium rate, it's inside this as well, like this order block. That price is what you see me annotating. So anyway, the opening price here, extend that forward. Every time we worked inside that, see that? What is it doing? It's building up positions inside the lower half of this candlestick, but there's no algorithm, right? How do we use PD arrays? If it's a premium array, we want to see the lower half of it utilized in the upper half, ideally not touched. That's that point here. I'm referencing that. Go watch the video. Go watch it at 0.25 speed. You'll see me annotating saying it's working the lower half of the discount portion, and it's under the mean threshold. Mean threshold is a reference point to a range like an order block. It's kind of like equilibrium, but when we're talking about a specific candle, it's mean threshold. In other words, its threshold for any type of retracements in and still being valid should be, if you're bearish, up close candles at the halfway point and lower. That's where all of your institutional buying and selling is going to be weighed on. In this case, we have up close candles. That's a bearish order block that's validated on this candlestick right here. As soon as we pass below that opening price there. So when we're bearish, we have that bearish order block validated here. So that means from that opening price, anything above that is a potential entry. But ideally, it should never go above the halfway point, which is mean threshold. See how it's doing that? It's staying away from that. That was signaling to me. That's why you see me adding more in there. I'm literally confident, like I could run through a brick wall. I know what I'm looking for, and I know exactly what I have in hand. And I'm like, okay, I'm done. I do one more pyramided entry, and then I just let it ride. And I want to see it attack all these pools of liquidity. The market is pausing in here, and it's all time distortion. Time distortion is where the market's being held in a holding pattern. So if we have this candlestick, the halfway point below it, between its opening price and halfway, all of this is potential areas where you could take a short entry. And your stop loss can be used with this order block, or you can use this high here, depending upon what your risk model and your account size affords. And that validates the order block right there. And so if you're seeing the executions there, they were live executions. Look at the price right there. I know I'm getting real premium pricing here because I'm outside of that fair value gap. Above this high, this is turtle soup. This is where smart money does the smart money short. Market maker sell model. Low risk sell order block. The high end of that fair value gap. That's what I'm aiming for, and I'm targeting right in here in this wick. I was trying to time it as it was inside the halfway point of that and that top of that fair value gap. That's what I was aiming for, but it slipped away from me because it's on a lower time frame 1 minute chart. That's what I was doing there. And then over here, You can see we're adding right there on the wick here. And then I'm aiming for this low to be taken out. And I said the market will aggressively reprice down there because the algorithm is not going to want them to pull their orders. Anyone that's long that has a trailed stop loss here, what kind of sell stop? I'm sorry, I just told you, didn't I? What kind of liquidity would be resting below here? Sell stops, because they're long and they're protecting their longs by putting a stop loss below an old low, because the books tell them that's where they should put their stop loss. So this low here, you see me annotate that, and then you see, so below here is sell side and below here is sell side, and then we have the original consolidation here. So that would be, you aim for a run below here. So there's where your pools of liquidity are and how the market will draw to them respectively. You see it drop down. That's wonderful. And then this is your first stage distribution of the sell mode. Watch my core content in the 2017 playlist. I actually teach this stuff here. So this is the first stage distribution, and then this is second stage distribution. Second stage distribution is your unicorn. So quick. It's so powerful. It's the one that you're looking for in every trade that you're looking for. Moving higher or lower, if you can identify my market maker sell model or buy model, if you trade the second stage redistribution, that means you're selling short, or if you're buying the second stage reaccumulation, that means you're going long, you are going to get the biggest, the fastest, the beautiful, easy hold trade that you're looking for. Everybody knows these relative equal lows are there, but not everybody sees the framework that causes this to be second stage distribution. What's this? It's a discount wick. But what happens if you're below it? It becomes what? A premium wick. Boom. How hard can it go above that? Well, you have a little bit of inefficiency here, but then you're met with what? Balanced range. This wick, previous wick, all this is balanced. So it's trading up into it, but it's saying, I'm not going to let you go any higher. You're going to stop right there. Turn it around, bro. And then rolls over. Where's it aiming for? Original consolidation. What's below these relative equal lows? Sell side. Okay, wonderful. But what happens if you just have a little bit more expected for lower prices like I did? Like I was telling you earlier in the week that we were going to look for this fair value gap on the daily chart that's defined by this blue line here and that black line that I made darker because I wanted you to see that was my target. You hold this one, but you can't trail your stop loss up to this high. You can't do that. So if you watch the recording, you'll see me outline the ranges of what I'm willing to absorb. And I gave you all this stuff up in here too. And I gave you the lower half. I said, I want to see price stay below that half. The market, in fact, does drop down and starts consolidating. And that low, I told you, that is the consequent encroachment of this gap between this level here. Boom, look at the bodies respecting that. See that? That's algorithmic. Sell side here, it aims for that. And then small little consolidation in here. What's it doing? It's affording traders to do what? The people that know that's going to trade for this level here and below here, it allows them to go short. But it's denying what? Harmonic traders, ratio traders, imbalance traders, support turn resistance traders can't get on board. Lower again, attacking that sell side. Why? Because they don't want the individuals that are long to pull their orders and get out of their long position, because that means their stop disappears. So the algorithm is re-delivering to that price level. It's coded to do this. This is script. It's a macro. It's something, it's a short list of orders and directives for the price engine to say, okay, I'm going to quickly reprice lower, quickly. All right, so that completes that day here. And I mentioned, like I said, I could have very easily just closed the trade right here because it's hitting consequent encroachment. And it would have been just a little bit above it for my limit order to trade there. If all I wanted to do was get the low of yesterday. This is the low of the day. I could very easily sold short here and bought that. And that's the high and low of the day. What discipline out there is going to teach you that? Nothing else. Absolutely nothing else. So I'm going to ride this out and all this consolidation here. I wanted to, admittedly, I wanted to add in pyramid here. But I wanted to prove that my stop loss claimant was grandmaster level. And then we had the previous new day opening gaps in here. I told you about that. And look what they did here. You watch it on the recording where they wicked up in the last hour yesterday, right at the last portion of the daily range. Boom! Why would they want to do that? Trailed stop losses here, inefficiency, balanced price range. That unseats trailed stop losses. They won't be able to see this hanging around what? This is the high of that daily fair value gap. And what is it doing? It's just marking time and drips down. And then gives you what? The buyers an opportunity to do what? Place what? Stops. What kind of stops? Sell stops. So this is engineering liquidity. It didn't go down to where I said it was going to go yet. It's building liquidity. They want to build liquidity around that level. What does the market do? Rallies up, consolidates. It's hanging around the upper quadrant of that daily fair value gap using old new day opening gaps, building fake bull flags. Oh, it's going to go higher. No, it ain't. Bang. And then watch. When we're getting close to this low here, the algorithm knows it needs to do it quick. Or you'll do what if you're long? You're going to pull your order and you're going to collapse your trade. They have to have the liquidity there. So the market does this quick drive down. Boom. And there's my exit rate at the low of the fair value gap on the daily chart. But here's the 9 o'clock run up. All this spending time above that daily fair value gap, above all this buy side here, and then they ripped it lower. And this is that lower wick that I highlighted on the daily chart. Let's go back out to actually I want to take a look at this. I didn't see ES. I haven't looked at it. I want to see ES real quick. Yeah, it made a higher high there. Look at this. This is ugly, isn't it? This delivery in ES, because I get a lot of questions. Why are you in NASDAQ and not ES? Because NASDAQ is a little bit more wild. And because it's more wild, it has a lot more likelihood that inefficiencies will be formed in it that won't be sometimes as clear in the E-mini S&P. So look at the difference between how this price action is here. This is like fuzzy, okay? It's like back and forth. Yeah, there's inefficiencies in here. You can see them, okay? But NASDAQ is a whole lot cleaner. And you can use the NASDAQ and still trade ES. Like you can look at the inefficiencies in NASDAQ when we're moving lower and say, okay, well, what is ES doing? And if ES is starting to retrace higher at the same time that the NASDAQ's trading up into a fair value gap and it's respecting its lower half of its inefficiency, you're not going to have mark to market perfect, the candles stop at the same time on ES to do a little stop on NASDAQ. If you're holding it to that degree of precision, it's going to frustrate you. But you can read price action in NASDAQ and get a good feel for what S&P is going to do. But if you look at what we have in NASDAQ, look at this area here. See how price is delivering all this in here? Contrast that with what you have in the NASDAQ. See how easy, and your eye jumps right to the inefficiencies here, here, and here. That is a stark contrast to what the delivery mechanism was in ES. So it's a little bit more fuzzy, a little bit more, it's like a muddying of the waters. It's still going to go where we think it's going to go, but it's not going to be as pristine and clear like you can see clearly with the NASDAQ. The inefficiencies go right into it and then breaks aggressively.